Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically the cash flow analysis. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to prepare their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Today we're going to talk about cash flow. It's what banks do. It's generally the repayment source for most commercial loans. Just like water in a water slide at a water slide park, business cash flow, or the cash transferred into and out of a business, is generally the slippery thing that makes it all happen. It's the primary repayment source for most loans, and therefore is very important to the stakeholders. Loans are underwritten with a comprehensive credit analysis to determine the strength and the trend of the primary repayment source. Positive cash flow indicates that a company has the ability to repay future debt repayments. Negative cash flow suggests there's too much spending. Cash flow originates from business activities, including its operations, the main activities of the company, investments like capital asset purchases, and financing, debt, equity infusions. Operating activities include direct cash receipts from customers and the collection of accounts receivable. Disbursements will include inventory purchases, general operating and administrative expenses, wage expenses, interest expense, and income taxes. Adding the receipts less the disbursements will show the net cash flow available from operations. Investing activities include cash receipts from the sale of property and equipment, the collection of principals on notes receivable, or the sale of any investment securities. Disbursements, on the other hand, will include cash paid for the purchase of property or equipment, loans made to others, and the purchasing of securities. The difference between receipts and disbursements will be your net cash flow from investments. Finally, financing activities include cash receipts from any stock issuances or new borrowings, and cash disbursements from any stock repurchases, dividends, or loan repayments. The difference in receipts and disbursements will be your net cash flow from financing activities. And then cash flow is analyzing several different methods, including the traditional method, the uniform cash analysis, direct and indirect, and free cash flow. Let's briefly look at a couple of these. The traditional method, basically it's the earnings before interest, taxes, depreciation, and amortization, or EBITDA. And this is used to cover any debt service requirements. This traditional method is often used because the needed information is easier to obtain and calculate, and when financial statements are insufficiently detailed. However, it does not recognize growth in accounts receivable or inventory. Do you think that would affect cash flow? Or a slowdown in accounts payable, or capital expenditures and other borrowings. So basically, again, to recap, the traditional method is to take the EBITDA, or earnings before interest, taxes, and depreciation and amortization, and then they get that number, which is the cash flow that's available before debt service. Okay, then they simply subtract the debt service requirement. What are the scheduled principal and interest payments? And there's either going to be an excess amount or there's going to be a deficit amount. Okay, and if you divide the cash flow before the debt service over the principal and interest payments, then you have a debt service coverage ratio. And another method for calculating cash flow, like I was saying earlier, would be the direct cash flow method. Over a given period, the cash flow statement will show the sources of cash which ultimately are used to repay a loan. Basically, it serves as a reconciliation of the bank's entire balance sheet and income statement by showing the net amount of net increases and decreases of activities on the balance sheet and income statement. And again, these are operating activities, they're the investing activities, and they're the financing activities. And then what about an individual, a personal guarantor, their cash flow? Personal cash flow for individuals who guarantee commercial loans will be determined by analyzing individual federal tax returns. To calculate the cash flow and debt service coverage using individual tax returns, the actual cash received will need to be determined together with all debt service requirements paid by the individual, their taxes, and their living expenses. And this can be done through an analysis of one's federal tax return. They get the wages and and all the net income or losses from the different companies, from all the different schedules, Schedule C, Schedule E, Schedule F, and that all adds up to, including their wages, to the beginning cash flow. Then they'll take out state and federal taxes, and they'll consider a reasonable amount for living expenses each year. And then that amount, if you deduct those taxes and living expenses, will be your cash flow available for debt service. Then they'll subtract the debt service requirements, and once again, there will be an excess or a deficient amount. And they can calculate a ratio that way too. And we'll talk about global cash flow, which is the consolidation of all sources of cash flow from all guarantors and all business entities related to a borrowing relationship. That's on a global one. But anyway, why is the cash flow analysis important to you? Here's what you do. Get on the same page with the creditor and convey you're doing your best. Hopefully you understand your own cash flow situation, because during an economic downturn, it's entirely possible there will be conditions of default like everywhere. Some loans may need to be materially restructured altogether because the numbers just don't add up. Until and when those conditions are present, you need to just do your best. That's it. Your ability to repay and the root causes for your current situation, this all needs to be effectively documented and communicated. Chances are you're very familiar with your financial statements, as well as the type of cash flow statements you're using to provide to the lender. If you're not real well versed in cash flow and need additional clarification, utilize your CPA or Google it up and research and review the numerous examples of cash flow statements. Determine the root cause behind any deteriorated financial performance. You determine that. You're obviously going to know what it is. You might have had a large accounts receivable that went bust. But show your lender you're doing your best, even though the numbers are underperforming. Talk about the numbers until there's a mutual understanding with the creditor of the same. Also, when you report to the lender, be sure your statements are from consistent periods, annually, quarterly, monthly, year over year, etc. Don't give them mixed up, unmatching dates, in other words. Year-to-date financial reporting for the interim period is also important. Consistent financial reporting makes it possible to observe trends and help eliminate any misrepresentation of cash flow for any given business cycle or reporting period. You should request a copy of the financial spreads from the creditor showing all your analyzed financial statements. The closer the stakeholders are on the same page with the creditor, the better. The more debt service coverage cushion, the better. When the creditor originated say it's a long-term loan, he no doubt installed a debt service coverage covenant. The minimum coverage was likely a debt service coverage ratio of 1.25 times. In other words, they want $1.25 of available cash flow to service every $1 of debt. There needs to be some cushion in there, obviously, because if it's less than 1-to-1, you may potentially fall short of being able to repay. Depending on the level of deficient cash flow, It doesn't necessarily mean that you have serious financial condition on your hand that you can't work out of. It may be an indication that your business is in a growth stage and you just need some more working capital financing to assist with the growth in assets, like to fund your accounts receivable and inventory. But if you're experiencing losses, don't expect the creditor to fund those losses with additional borrowings. If you understand what's causing the losses, you should be able to make certain decisions to remediate the same while renegotiating your existing debt. This ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Thoroughly know the root cause of any cash flow deficiencies. This has got to be repeated again. Let's assume that there are structural long-term issues affecting your cash flow, like a sustained decline in sales revenues or other increases in operating expenses. In a severe case, this will likely end up being a modified loan workout situation if performance doesn't improve in the short term. Therefore, you have to absolutely know and understand the root cause of there being deficient cash flow. If you understand the root cause, you'll know the solution and how long it will take to remedy. Just don't assume the lender knows and sees what you do. But if you don't fully understand the actual reasons, you can't properly fix the problem, and you'll lose or frustrate your credibility and your relationship with the lender. So you have to be well prepared and make a repayment plan to fit the problem that caused the stressed cash flow. There's nothing wrong with communicating with a lender either. Maybe the stakeholders could use a few minutes visiting and discussing performance. Again, you have to know the root cause so you can fix it, knowing how you will do it, when you will do it, and how much it will cost, etc. Ask questions and talk to your CPA, the creditor, and read on. But don't stop digging until you know and understand your cash flow picture, how it came about, how it will be resolved, and document your assumptions or your way out of it. You can't just give him rosy projections, 10% increase in sales. But if you're going to do that, you've got to put a footnote and explain why that assumption is rational and reasonable and how you're going to do it. You need, in other words, to present a repayment plan to your creditor and convince them to accept it. It's got to be reasonable, and that's prudent, or otherwise reach the best possible win-win arrangement. If you really get it and are totally convinced you can and will bring the plan to fruition, getting to that level of commitment is called ownership. That's where you need to be. This will come through loud and clear to the creditor. He needs to see that you own this. Okay? You're the captain of your ship, but, again, the creditor needs to feel secure enough that if he decides to jump into the boat and do a workout with you as you head out to sea, he will be okay and make it to the intended destination. You need to see and appreciate the position it and the other creditors are in as you address your cash flow dilemma. Take a fresh look at your current balance sheet. What's the relationship of debt, or the creditors, to equity, you? You thought you owned all your assets, right? That is the case, but how much of those assets do the lenders have as a senior priority interest in versus your interest? It's likely the lender has a larger stake in those assets than you do. If the leverage, again, that relationship of debt to equity, creditor to you, is, say, 2-to-1, in other words, the creditor has 2 times more debt capital than you have equity capital. If it's higher, say, than 3-to-1 or even in a 5-to-1 plus range, well, you pretty much had better be well prepared in presenting your repayment plan. Why? Because the creditors would have 2, 3, 5 times more interest in the business assets than you do. That's why. So appreciate where the creditor's coming from. How to get to being prudent by your best efforts in a downturn. When you ask creditors to get in your boat and go out to sea with you, depending on the leverage, okay, they have a lot more to lose in the business than you do. Yes, the creditors generally have much more to lose than you do. So before you think this is all about you, do your homework and be well prepared to have a legitimate and compelling conversation or conversations. You are certainly empowered to do this because you're the one who signed the promissory note and the loan agreement, not to mention a personal guarantee. So you have a big voice in this. When there's an economic downturn, it can't get beyond difficult, because if the money isn't there, it's not there, right? So what do? You do your homework and let the documented debt resolution plan be based on a best efforts basis. In other words, it is what it is. If it's horrible, it's horrible. But it's your best efforts, okay? It's not what the creditor wants to see. It's what you know you need to do to have to survive and repay and work yourself out of it. Sometimes that's hard to reconcile in one's mind because they know they must meet or exceed their covenanted financial performance threshold. But it's just not possible sometimes. So you must go to best efforts mode. Your pro forma cash flow statement will have to project that. It's okay if that's what it is. The creditor will recognize remember that ownership and your effort, the root cause analysis, you're documenting your assumptions. Although the cash flow will probably not be what he expected, and will likely be much less, and perhaps a ton less. But it is your best efforts plan. Therefore, your plan should be considered with a prudent plan that both can agree upon. It will be a win-win. Lenders are supposed to be prudent lenders. That's how you get to being prudent. It's got to have all those elements to it. Again, this is not a one-and-done repayment pitch. When you're out to sea for a few months with your repayment plan, in other words, you're 2 or 3 quarters into this repayment, update your financials and send them to the creditors, regardless if there is a financial reporting requirement to do so or not. Take ownership. Show the creditor. Do you see what I'm saying? Show the creditor that you're performing to plan, or you're not. But be proactive and defend your financial performance. If you're ahead of schedule, explain why. Communicate. Overly communicate. Build a relationship of trust, clarity, and understanding. You may need the creditor's assistance soon, possibly more than once or twice, which is perfectly fine. This isn't a one-and-done situation. You're going to stay with this until the issues or problems are resolved, and if necessary, until your loans are repaid. Also, please don't take any of your creditors for granted, any of them. Creditors will likely have more into your business, like I said, than you do. And it may always be that way for most small businesses during those early growth years. So don't take any of your creditors for granted, be they the vendor suppliers or the long-term lenders for your office or your warehouse. They granted you credit in good faith that you will repay pursuant to the underlying terms and conditions, and likely have charged you with a competitive and reasonable market rate of interest and fees. So when your cash flow is deficient, that's not the creditor's fault. If you see yourself blaming your creditors for your problems, then please think again. Based on your experience, you'd be mistaken to not demonstrate full ownership for your business, and therefore well advised to reconsider your relationships with each creditor. Seriously, who is responsible for, and regardless for the reason that caused you to experience financial difficulties, the deficient cash flows? If you're the owner, then you're responsible. Your decisions may not have led to the deficient cash flow, but you still own this business and you're responsible for it. So act like it, especially if you made decisions that have negatively impacted your cash flows. And negotiate in good faith. You should and will be expected to live up to all the terms and conditions of your promissory note and loan agreement, even if they have to become amended or modified, which can happen. Thank you for joining us today. Today we covered the Creditor Tool cash flow analysis. as debtors prepare to propose their own repayment solutions. We hope and we want to hear from you. Please share your credit risk memo and debt repayment experiences, questions, recommendations with us at nicara.org. If you found today's episode useful, please subscribe for notifications of future podcasts. Your feedback helps other small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.